Richard, Head of Trading here at Corporate to Retail, and I just want to give you a brief rundown on how I see the markets, what's going on at the moment, what I think's running the show. It's been an interesting last few days. I think after the volatility that we saw throughout February and March, when the market was clearly caught short of dollars, and we saw a big rally in the yields in the US 10-year. I just think over the last 4 or 5 trading days, we've had the Easter weekend, bank holiday on the Friday, bank holiday on the Monday, and things have just calmed down just a little bit, and the market is sitting there waiting to see what happens, what the next big move is. The market was clearly short of dollars earlier in the year, and we saw the US 10-year rally from 0.9% up to 1.8%, and we saw the dollar take off against pretty much everything. Over the last few days, the 10-year is back down to 1.64. We've seen a bit of a drop in the dollar. It's all connected. It's all going together. So we've seen a bit of a bounce in euro dollar. We've had a bounce in Aussie dollar, Kiwi dollar. Dollar Swiss is lower. I get an awful lot of bank reports each morning, and every update, the first thing that they're all mentioning is the yield, is the US 10-year. Now, it's not something that I've really paid too much attention to for many years, but over the last 2 months, it's clearly running the show. So Google it, live US 10-year price, and you'll be able to see it. Have a look at what's happened over the last 2 or 3 months, and just leave it up and running so you can see the correlation. The FX world is full of correlations. You know, I go on about it all the time, whether it's metals, equities, oil. There's all these connections all over the place. You know, COVID, risk on, risk off, etc. So, and what's running the show today in a month's time might not be the case. We saw a surprisingly good non-farm number last Friday, I think it was, Thursday or Friday. A lot better than expected. We've got FOMC later this evening, 6 p.m, 7 p.m. That'll be interesting to see what the US make of that. That's always key, but in the current times, with the yield play being so significant, that'll be interesting. Over the last 3 or 4 days, we've seen the dollar a little bit lower. Probably Canada is the one exception to that. Dollar Canada up at 126, maybe 300 points off from the lows. That is still an oil play. Oil was up at $68, now down to 58, 59. COVID is having a big play there with what's happening with oil, and then that kicks off into dollar Canada. What this dollar fall over the last 2 or 3 days has given us, it's given us levels, key levels to keep an eye out for next time they get there. So, for example, we had, let me just call it up here. We had euro dollar down at 117, sterling dollar down at 136.70, dollar yen up at 110.90, Aussie dollar 75.30, Kiwi 69.5. One of my last updates, I mentioned just a little tip about setting yourself up an MT4 demo account. Stick these levels on your demo account, so when they get close, we know that something's going to happen. That level will either hold again, or it will break through and we'll move. It will shift into a new, 200, 300 pip range. So those levels I just mentioned, put them on your demo account. Just to remind you, And remember, if they're all there together at the same time, which could quite easily be the case, if euro dollar is down at 117 and sterling dollar is down at 136.70, dollar yen 110.90, if they're all together at the same time, that gives added strength, added importance. So it'll be tough to crack. But if it does crack, if we do break through those previous dollar highs, then that could be a significant breakout, a significant move. Keep an eye on external markets. You've really got to watch this 10-year, this yield. It is so key at the moment. Gold, I'm always going on about gold. It's just another FX pair, but some of the flows that go through that can be quite key and can give the dollar a shift one way or the other in other markets. Even Bitcoin, it's important now. 2 years ago, a year ago, the banks weren't even mentioning it in their reports. Now, with what's going on, these big players are mentioning Bitcoin on a daily basis. I still think sterling should be avoided. I think it's just up and down, 150 points, 200 points, no real feel to it. I think there's as much chance that we see 132 next as I do we see 142. I think there are better pairs to trade. Just one other thing. I mentioned last time about Googling a FX Squawk box. You get a free service and you'll get free updates. If there's data out in the next 10 seconds, you'll hear about it. If the president or the prime minister have come out with a statement, there's been a hike or a cut in interest rates, etc. Get a free Squawk service. But something else you can always get: Daily FX and FX Street are two retail-based platforms out there. Very good information flow. So if you're just sitting there, have a read of those in the morning. They give you early morning updates. If there's been a massive move in gold or equities or whatever it might be yesterday, you can read about it through these on these platforms, Daily FX and FX Street. It just helps in the educational process. So that's about it for now. Keep watching that 10-year and safe trading, and I will speak to you soon.